Hello and a very warm welcome to Econoday Unplugged on Wednesday, the 12th of April 2023. Terry Sheehan's on the US East Coast, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. The surprise decision by the OPEC Plus group to cut oil production earlier this month provided a fresh and, for most, unwelcome boost to inflation. However, there are signs that at least some investors and central bankers are starting to worry about growth. Just yesterday, the IMF forecast that the medium-term global growth outlook would be the weakest since 1990. True, the OPEC announcement caused crude prices to spike by 8% or so, but that could have been a lot more. And since then, bond yields in the US have declined, and Europe bond yields are still below last month's peak levels. Now, that's not to say that in most G7 countries, the next move in official interest rates won't be up, but with the likes of the Bank of Canada and the Reserve Bank of Australia already, at least temporarily, on hold and splits over what to do with policy elsewhere, typically widening, it may be that slowing economic activity is now having more of a say in determining how much higher interest rates will go. And on that note, for a change, let's go to Brian first to see what's going on at the RBA. So, Brian, having tightened at the previous 10 meetings, last week the RBA announced no change in its cash rate target. Why? What's changed?
Yeah, well, I think exactly as you're mentioning, they're starting to think about what impact this is having on growth, and also starting to I think appreciate just how much of an impact the policy tightening they've already had is having on their main focus, which is inflation. So before the RBA's meeting at the start of the month, we did have them say in the minutes to the last meeting that they'd be looking at retail sales, employment, and monthly inflation numbers to see whether it would be worth pausing this month. And those numbers, did sort of show still solid conditions in the labour market, but weaker growth in retail sales, and most crucially, a drop in that monthly inflation number. So I think that gave them the green light to say, okay, we can press pause, for the time being at least. I don't think that rules out more rate hikes further down the road. They haven't said this is definitely the end of the tightening cycle, but it's clear that they are starting to see the case for keeping policy on hold for the time being, if we do see that inflation number continue to go south.
Okay, you mentioned retail sales there. Previously on the podcast, you've been talking obviously about the CPI, but also the labour market. As you mentioned, obviously, we'll get the labour market report later on today. Are there other sort of things you think there's indicators now that we're moving away from perhaps just looking at those two indicators, or at least for labour market with regards to what's going on to the real economy, to looking at other indicators of demand or perhaps output, whatever it may be? So is there a sort of broader spectrum, do you think, of indicators they're looking at now, or is it still a fairly sort of perhaps a relatively narrow group they're focusing upon?
I think inflation is still the number one thing they've got to think about, and that's the one that they're mentioning most of the time. But they've been pretty adamant now for 4 or 5 months that they did think that inflation peaked at the end of last year, and that we are going to see this gradual decline. But they're still not predicting that they're going to be back within the target range until for another couple of years, basically. And so, that said, that means they still might be biased towards some further moves in rates. But as you mentioned, the IMF is starting to warn about the global outlook. They themselves have said now that there's actually a very narrow path for them to be able to get inflation down without tanking the economy. So they're concerned about that on the other side. And so, there's going to be, a bit of, a lot of judgment, I think, is going to be required over the next 6 or 8 months. And you're right, they will be looking at a range of data. And so, we'll have to keep an eye on all those data releases as well. But, inflation still is that number one target.
Okay, I guess from what you're saying, it may or may not be the case that interest rates have topped out, but perhaps if they haven't topped out, they haven't got too much further to go. But how soon do you think it might be before we actually see rates start moving in the other direction?
I think that's still a way off. So, there's not much talk of them starting to unwind some of this policy tightening, but just, hopefully not too much more, because, we are definitely seeing concerns about consumer confidence and the housing market and the input and the labour market. So there is a lot of anxiety out there, I think, if they do continue to keep tightening aggressively. But now that they have paused at least this month, that might just let people breathe a bit easier.
Okay, RBA then. So let's move across to New Zealand. Also, last week, clearly the RBNZ had been one of the most hawkish of the central banks in recent times. They raised their interest rates again, but by only 25 basis points rather than the 50 basis points.
No, they went 50.
Sorry?
No, they went 50.
Oh, we did go 50. Sorry, my apologies.
Yeah.
Sorry, quite right. So I'm reading the wrong notes here. Okay, we did another 50. So what kind do you think of the chances now that they are too getting toward the top end of their cycle, or are they still very much focused upon what's going on in inflation?
Again, inflation is still the number one thing that they're focusing on. They've also complicated by the fact that they have had the cyclones and the poor and other adverse weather events in recent months, and they said at the time that that's going to put further pressure on prices in the near term, and that's likely to be the case. You're right though that they have traditionally also been more hawkish than the RBA over the other side of the Tasman Sea, and so it's perhaps not surprising that they do go a little bit further. But again, I think you'll see that that they're going to be focused on inflation, but also mindful of the impact that this aggressive tightening they've had will have on the growth outlook. But if you read their statement, they're still sort of not indicating. They're still indicating that inflation is a focus, and they've got to do what they need to do to get that down.
Okay, has there been any we talked a bit previously on earlier podcasts about the impact of the really bad weather we've had out there? Has that had any kind of input into their decision making?
Well, I think they're trying to say we're going to look through it because we recognise that it's had an impact, but it should be a relatively short-term event. So I don't think that's having a big impact on their decision. But they have said that we're going to have higher inflation in the short term. It's also going to have a bit of an immediate cut in activity, but then a boost of activity later on as rebuilding efforts take place. So I think it's pretty standard though for central banks to try and ignore the noise from some of these factors and try and focus on the bigger picture. And I think that's what they'll do. But the bigger picture, I think, for them is still telling them that inflation is their number one concern.
Okay, fair enough that one. If I go and get my numbers right this time, Reserve Bank of India. There we saw no change coming out of their April meeting against the expectations of 25 basis point increase. So is this a similar sort of story to the RBA where perhaps we're coming to the top end of the rate cycle?
Yeah, I mean, I guess if you want to look, big picture, we've had 3 out of the 4 sort of key central banks who do move their policy rates pretty regularly. Mm-hmm. India, Australia, New Zealand, and South Korea. Perhaps we can talk about South Korea in a minute. But 3 of the 4 have paused in the last couple of months. So, I just think that's indicative of the point you said right at the top of the show that we're seeing a focus on inflation continuing, but still being mindful of the impact that this is going to have on growth. Now, in the case of India, we've actually seen the headline inflation number come off over the last 2 or 3 months. I think we had the inflation numbers just yesterday, and that saw headline inflation back within their target range of 2% to 6%. It fell, it was 5 point something, 5.8 I think percent yesterday, and so it's back at least within that target range, and that's only I think the 3rd time since the start of last year that it's been within that range. So that is obviously a positive sign for them. Obviously the Indian inflation numbers get bounced around quite a bit by food prices,
right?
But just the fact that it's trending in the right direction, I think is positive, and they're I think again mindful of all this tightening that they have put in place already, and that obviously it's going to have an impact with a lag, and so it was obviously a period, an opportunity this month for them to say, okay, we'll just hold for the time being.
Okay, fair enough on that one. Right, let's round off then with, well, so you mentioned South Korea. Before we get, let's go on China quickly.
Yeah.
We had their CPI out the other day, and again, very weak. Well, the inflation rate out there just 0.7%. So is it still the case if we see any kind of additional policy changes in China, it's more likely to be an ease rather than a tightening?
I think so. I mean, they did reduce bank reserve requirements a little bit a couple of weeks ago. So not a big policy move, but I think indicative of their overall stance at the moment. That they're not obviously in a tightening phase of policy, and if anything, they're just trying to keep things a little bit accommodative as they continue to recover from the pandemic and public health restrictions impact on economic activity. So, we're not seeing, I think, a very strong recovery out of that. We were hopeful at the start of the year that all those restrictions that they eased at the end of last year would have a very immediate impact. As you know, the data gets a bit cloudy in the first couple of months because of Lunar New Year. So it was a little bit hard to see whether we were getting a really strong recovery. But if you look at the March numbers, it's kind of just sort of ambling along. It's not a very very impressive recovery so far. So I think given that, we're not going to see much of a move on policy. If anything, there might be a bit of fiscal or infrastructure spending to try and give things a bit of a boost.
Okay, fair enough. Okay, then, so you mentioned South Korea. So you mentioned talk about South Korea. That and anywhere else you'd like to put in before we move on?
I mean, no, just that one. Also, we've got Singapore's semi-annual policy statement coming tomorrow. So just keep an eye out for that. So people might recall that they adjust their policy using their target. They're using their exchange rate. So they have in the last couple of times at least eased policy by using that exchange rate target. So it'll be interesting to see if they do that again tomorrow.
Okay, fair enough. Excellent. Thanks for that, Brian. I'll just quickly round off with Japan. We don't have Max with us today, so to be honest, there's not a great deal to say about Japan anyway, but I suppose it is worth pointing out that first quarter GDP, it's not looking too bad at the moment. Both the February retail sales and the industrial production numbers were surprisingly strong. But just earlier on today, we had the deputy governor coming out indicating that the BOJ will continue monetary easing in order to achieve our price stability target sustainably and stably. And that's very much consistent with some of the other comments we've had coming out from the central bank, really suggesting that there's going to be no change in the yield curve control program anytime soon. Right. Okay, then let's move across to Terry and the States. Terry, it's I guess a little while before the next FOMC meeting. But over the last few days, you've had the employment report, you've had inflation update, and even some FOMC minutes as well. So are there any signs that US rates might be close to peaking?
Yes, I think so. The March CPI data was quite a bit of a downside surprise at the headline, although the core was up actually a little bit. But there's still some indication that rate hikes are finally beginning to have their effect on non-housing services, which is what the Fed's been talking about a lot lately. And it's with the labor market continuing to perform fairly well, there is still room for another rate hike in there, I think.
I was going, at the moment, I don't know, it just seems to me that there's almost something for everyone in the data currently. And there seems to be, different, conflicting viewpoints coming out of the various FOMC members and certainly analysts as well. I suppose it's kind of difficult to work out just what's going on states-wise. Is it kind of recovering? We'll have a decent growth this year, or is it starting to peter out? I suppose, as you mentioned, though, it's going to be key to look at the more interest rate sensitive sectors. And you touched on it there. So are they really offering clear signs now that growth is being impacted by, well, let's be honest, what's been aggressive Fed tightening over the last year or so?
Well, if you look at the FOMC meeting minutes, which admittedly are now 3 weeks old, they were really concerned about the impact of the disruptions in the banking and finance sector that I started early in March. But those seem to have eased up considerably. So now I think it comes down to, as a result of that little crisis there, are we going to see a tightening in financial conditions that's going to hold on longer than expected? So and right now we've actually seen some, good economic activity for the housing market because mortgage rates come down a bit.
Right.
So, it's definitely a mixed bag out there. I mean, we are seeing overall improvement in inflation, but this morning, the Bureau of Labor Statistics, which puts out the consumer price numbers, noted that shelter costs, essentially rent, have been keeping the core high. So are we going to see relief in terms of what people are paying for rent or their equivalent in rent from home ownership? There are signs that the manufacturing sector is slowing down, but the service sector slowing as well, but not nearly as much. So, it really is a mixed bag out there. The next report we're going to be seeing is the March data on retail sales on Friday. So if consumer spending is holding up, it looks like the U.S. economy has a good chance to get through 2023 with the subpar growth that the Fed has been forecasting.
Could we be talking soft landing? Well, something I would say Brian mentioned when he was talking about perhaps one of the reasons why the RBA didn't do anything in their latest meeting was because of the fact that they've tightened aggressively so far. And we all know that monetary policy operates with these long and variable lags. So it needs time to actually, for the full effect to come through. Was there any sign of any kind of discussion within the FOMC when in today's minutes?
Yes, there was, in fact. I mean, there was clearly a debate whether, it was time to pause or whether they needed to do 50 basis points and not 25.
Right.
They reached their consensus on 25, and it seems to have been agreed by everyone. But yes, some members of the FOMC do think that we need to slow down for the moment and let the impact of past rate hikes catch up with us. And there are some who are still more worried about inflation becoming entrenched. Now, we have seen that some of the measures of inflation expectations have stabilized or come down a bit. So they actually have probably enough leeway to do another 25 basis points, but I don't think we're going to be seeing more than that. And it is depending on what the data looks like for the rest of the month. When they meet on May 2nd and 3rd, I mean, they may well decide to pause.
Do you think at that stage they would actually come out and intimate, like we've seen with the RBA and certainly in particular with the Bank of Canada, to indicate, well, look, if things start developing or evolving as we anticipate, we won't be looking to tighten up the next meeting. Would they come out and be that specific, or will they keep it open?
They'll keep it open. They also like to say that no decision is made before the meeting and that policy is never on a preset course. So I think we have to wait until we see all the data before the meeting.
Hooray for the data, eh? Great. Okay, Terry, thanks for anything else you'd like to put in before we move on.
No, that's it.
Okay. Lovely. Okay, thanks very much, Nick, as I'll round off the other bits and pieces. As I mentioned earlier, Bank of Canada then. So earlier today, the BOC announced no change in policy for a second successive month. So the overnight target for the cash rate, the overnight target remains at 4.5%, and they'll continue with the current round of passive quantitative tightening. No surprises there. It's very much consistent, as I mentioned, with the so-called pause statement they put out back in January. That's the last time they actually tightened rates by 25 basis points. I'm just looking at some of the bits and pieces surrounding today's announcement. They updated their monetary policy report, so we have some new numbers to go there. I guess first thing people might have looked at, well, first quarter growth is clearly outperforming. They've revised up their GDP number for the first quarter now to season adjusted annualized growth of 2.3%. That compared with just 0.5% in the previous MPR. But against that, they've got it slowing down to just 1% in the second quarter. And indeed, into 2024, the growth picture there now is seen at just 1.3%, down from 1.8%. So not too much really to mess around with policy on the back of that. And indeed, they also expect inflation to fall quickly to around the 3% mark in the middle of this year. And then it will be a more gradual deceleration to 2%, the target, effectively the middle of the target range by the end of 2024. They noted inflation expectations are coming down, still have some issues though with service price inflation, and wage growth remains elevated. But if you kind of put all these little bits and pieces together, it really suggests that policy could well be on hold in Canada for the time being. It does seem increasingly that rates have certainly topped out there now, but they also seem to be in no particular hurry to come out and reduce interest rates. The fact that they don't see inflation getting back to target until the tail end of next year really suggests that they're going to have to keep rates at current levels for perhaps some while. And indeed, they actually admitted that the BOC meeting discussed the need for rates to remain higher for an extended period of time. But it looks as if there could be fairly flat rates in Canada for a little while to come. Okay, then across to Europe. Well, I guess the ECB has been emerging for a little while now as one of the more hawkish of the central banks. And I suppose that's very much reflected really in the level of the euro. We've got highs against the dollar, what we haven't seen these sort of levels for the best part of a year or so. But like the Bank of England and many other central banks at the moment, there are disagreements over where rates should be heading. Certainly within the governing council, some of the southern Mediterranean members are clearly less enthusiastic about higher interest rates than the likes of Germany and Austria, both of whom seem to want another 50 basis point hike when we get to the next meeting in May. Indeed, the hawkish members are also calling for an acceleration in the quantitative tightening program once we get beyond June time. Why? Well, it's, I guess, a bit like the US really. The picture is a little bit mixed for the Eurozone. In terms of the real economy, the first quarter started off pretty well, mainly on the back of a rebound in Germany, manufacturing at long last starting to show some real signs of life. But against that, overall Eurozone retail sales are still struggling. Indeed, they may well subtract from first quarter GDP growth. And GDP itself, I guess at this stage, looks like it'll probably only up about, what, a 0.3% quarterly rate or so. So very much nothing to write home about. And also of note, looking at some of the financials, the bank lending data in particular are showing signs of responding perhaps quite rapidly now to the increase in interest rates we've seen so far. Nonetheless, of course, for the ECB, perhaps more than a lot of the other central banks now, it's still inflation which is completely dominating what happens to policy. We'll get the next flash HICP, as they call it, for May. That's due on May the 2nd, so just a couple of days before the May announcement. But with the core rate already at a record 5.7%, and that's climbed every month since last November. And with, as Terry was alluding stateside, the banking sector issues now not being such a threat perhaps to policy, it's difficult really not to see the ECB tightening again once we do get into May. There have been some better numbers on inflation expectations, but bottom line for the ECB, core inflation has been trending up for so long now and is so far above target, they almost guaranteed to be having to be seen to be doing something once we get into the next meeting. All that said, it may be that we're starting to get towards the top end of the ECB interest rates as well. For the UK, very much the mixed message still coming out of the Bank of England Monetary Policy Committee. And I think that just highlights the fact that the economic outlook for the UK remains hugely uncertain. Silvana Tenreiro, who's one of the external MPC members and perhaps the main dove now, she came out the other day suggesting, or at least hinting, that she might even vote for interest rates becoming down soon. And that's a big contrast to some of the more hawkish members like the bank's chief economist, Hugh Pill, who still sees inflation as too high and rates need to go up. So these widening splits, well, they may not be enough to stop rates going up again in May, but they probably do mean that we wouldn't see anything more than 25 basis points or so. Elsewhere within Europe, I should mention the Swiss National Bank. Again, they've been pretty hawkish, despite the fact that inflation by and large has been fairly low. And on that front, we saw a surprisingly soft March inflation report. The headline rate there was down to 2.9% after 3.4, a good deal softer than expected, although it's still only a 3-month low. And the core rate also fell to 2.2% from 2.4%. At the same time, we've got Econoday's Economic Consensus Divergence Index that shows that the Swiss economy is underperforming expectations as well at the moment. So although given it is the Swiss National Bank, who certainly don't mind surprising markets, and they really are as anti-inflation as any other central bank, they could still raise interest rates at their next meeting, and that's not until we get towards the end of June time. The way things are shaping up at the moment, again, it kind of suggests that interest rates in Switzerland, like a number of other central banks now, are probably getting somewhere close to the top end of the current cycle. Okay, then. Well, I guess that's probably about it for us for today then. What can we say? Well, I mean, since these central banks really started the current tightening cycle back in, 2021, we've seen official interest rates go up some 475 basis points in the States, 450 basis points in New Zealand, and 425 basis points in Canada. The UK isn't far behind. We're up 415 basis points. And even the typically slow to react ECB has raised by 350 basis points. Now, the increases may have been from very low levels, but once you add in the RBA's 350 basis points, the SNB's 225 basis points, it really means that the global monetary policy stance has become hugely more restrictive. And perhaps that's why policymakers now seem to be rather less dismissive of the risk of policy overkill. In any event, with data dependency, the typical central bank's main mantra still, it's important as ever to keep on top of all the key economic statistics, and they can all be found as ever in Econoday's global economic calendar. So please do take a look. And with that, on behalf of Terry, Bron, me, thanks as always for listening. We hope to see you again next time. Bye for now.